But I think most of us inside and outside the system see gold at 10, 12, 15, 20. I was talking to Pierre Lassonde. He's obviously a clear expert in the mining space, but he could say with a straight face, in our lifetimes, we'll see $20,000 gold. Does that mean it's tomorrow? Does that mean gold doesn't go down? No. Does that mean I'm absolutely certain? No. But that's the conviction I have, because gold can go to those levels only because fiat money has really no options left. For me, gold at 15, 10, 20,000 is the real end game. And even then, I save in gold and spend in fiat. It's insurance. That's it. It's a preservation asset.
Gold is entering a decisive phase in its long-term monetary cycle as global investors confront the limits of debt-based fiat systems and the growing inevitability of a significant market reset. Structural pressures, including de-dollarization, negative real yields, and rising geopolitical instability, are driving a sustained shift toward hard assets. At the same time, historic patterns of mean reversion, overextended equity valuations, and liquidity fragilities are setting the stage for an uh-oh moment, where confidence rapidly unwinds and capital seeks the most reliable stores of value. Matthew Piepenburg, a respected global macro analyst, emphasizes that gold's trajectory is tied less to speculation and more to the structural decline of fiat purchasing power. This is why long-term targets of $10,000, $15,000, and even $20,000 gold are no longer fringe projections, but logical outcomes of a system stretched by debt, money creation, and weakening trust. During stress events, gold can temporarily retrace, just as it did in 1975 and 2008. Yet these declines historically become powerful entry points before the next surge. With central banks now holding more gold than U.S. Treasuries, institutional demand is shifting in a way that didn't exist before 2008, reinforcing gold's role as insurance against currency debasement and systemic shocks. Now, we present the clips from Matthew Piepenburg's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Central banks now hold more gold than treasuries. But what Henrik is saying is there will be an uh-oh moment at some point. We can't time it. He's calling, and I agree, for a frothy blow-off top. You can never time a market crash. You can certainly measure and track a market bubble. But as Jeremy Grantham said, timing that is really a mug's game. No one can. I can't. Henrik can't. But it's somewhat the law of mean reversion. At some point, this market crashes. And what he's saying is, and I'm simplifying, but it's true, and he deserves the defense, that if and when that uh-oh moment occurs in this massive, objectively obvious market bubble, there will be fear. And when there's fear, there will be a flight to the best lifeboat. To use another metaphor, that lifeboat would be the sacred cow that is the 10-year U.S. Treasury, the tier 1 asset, the BIS, alongside physical gold. And he's saying you'll see a rise in bond demand. And of course, as a rise in bond demand, yields should be coming down. But yields can move in different directions. I think why we're seeing gold and bonds moving in a similar direction is there's a similar fear in the world. And to Henrik's point, when that fear manifests itself, U.S. Treasuries and the U.S. dollar indirectly will be the safe haven, the lifeboat. And gold will be too, but it will be the dollar first and U.S. Treasury first and the DXY spiking first before gold becomes really obvious. Because I think when these markets tank, there'll maybe a run to U.S. Treasuries, there'll certainly be a run to the U.S. dollar, and that's the whole DXY debate, that the DXY will go past 120, 130. My argument, it could be wrong, is there'll be an equal run to physical gold because we're already seeing that pre-crisis. Henrik's point using 2008 market example as well, but last time we saw an uh-oh moment in the markets, gold lost 30%, and it will do that again. By the way, gold will never go in a straight line, and there is volatility in gold. Anyone investing for the long term needs to be a big boy and a big girl about that. We talk about we are in a bull market in gold. People say the gold price is going down, 8%. I said, really, it's going down from 2,000 to 4,000 in the last 18 months. Gold's going down. But if there's an 8% retracement, that's like the end of the bull market. It's not. And I think I should remind, between 1971 and 1980, gold went from $35 to $850. That was a major bull market in gold. Huge percentage increase, much farther than this one. But in 1975, gold lost 50%. Although it was on its way to $850, it went down to $260 and then some. It had a major uh-oh moment as an asset in the middle of its bull run, is all I'm saying. So to say, even if you're very high conviction on gold, that it really only goes north is dishonest. But it can have cyclical declines in a secular bull market. And to Henrik's point, we could see a major retracement in gold, which for me is like, as Rick Rule said last night at dinner, it's like a fur coat. If it goes on sale, buy it for your wife when it's on sale, but still buy it because it has value. If we see a buying moment in gold because of an uh-oh moment in the markets for liquidity or to cover margin or for any reason, I would just buy more, because the larger case for gold is it goes up because paper money goes down. And that's inevitable, because as Henrik and Francis and I all agree, when that uh-oh moment comes, when there's a crisis, the central banks will inject fire hoses of liquidity, QE to the moon, which will further debase an already debased dollar. That's the end game, as Paul Tudor Jones says. All roads lead to this. And I agree. And that's just another tailwind for the gold movement. But I think it might be different in 2025, 2026, 2027, whenever this uh-oh moment comes. And we clearly see the bubble. When it pops, there's all kinds of things that could pop it. When it comes, I think it could be arguably different than 2008, because in the last many years since 2008, central banks have been stacking more gold than treasuries. We see a clear, it's not just conspiracy theory anymore, a clear de-dollarization trend. We see it in the petrodollar. We see it with the BRICS. We see it with net settlement. We see Saudi Arabia buying, selling oil in yuan. We see a change. It's not the end of the dollar, but we see a clear change, very different than pre-2008. We see a clear trend since 2014 of central banks net stacking gold and net dumping U.S. Treasuries. We see central banks now, as of this moment, own more gold than they do U.S. Treasuries, which was unthinkable years ago. We see oil outside the petrodollar at 20% global sales outside the petrodollar, unthinkable 5-6 years ago. So we see Morgan Stanley offering a 60-20-20 portfolio with 20% gold, unthinkable pre-08. So what I'm saying is there's evidence that gold is far more necessary as an asset than it is contrarian as it was pre-08. And that's why I argue it's very possible that the next uh-oh moment will see actually, possible retracement in gold. But I think we actually could see a run to gold in a more institutional way than we did in the '08 crisis. That's my theory. I don't know. It could be a major uh-oh moment for gold temporarily. That doesn't bother me because it's a buying opportunity. Because again, in a major bull market in gold, which we're clearly entering, you can see retracements. If you understand the reason for holding gold and you're not buying and selling for a quick trade and you're not trying to speculate in a quarterly fashion, it really shouldn't shock you. But I wouldn't wait for that retracement before you get in, because that could be a retracement of 30% when gold's at 8,000 or 9,000. When Henrik and I met in South Africa, gold was what, 2,800, 2,700 earlier this year. And if there was a 30% retracement then, he would have been right. But if you waited for it then, you'd have missed out on the rise to 4,000. If we saw a 30% trace today, it'd still be higher than it was when we met in South Africa. So you can't time your entries. If you understand the longer term reason for holding gold, again, simply put, it's insurance for dying paper money. It's life insurance for dying paper money, the evidence of which is literally everywhere. It's way past the gold bugging camp. Even the Bitcoin crowd, which I respect, understands that. So, it's just one insurance policy against an openly, obviously dying fiat currency system from the debt-based disaster. So if you understand it that way, you're not going to be worried whether you bought gold at 4,000, 3,700 or waited for a pullback, because I and many others beyond just the gold camp, which are obviously in our bias circles, in our yes circles, and possibly could be guilty of data searching rather than data analysis, data digging just to confirm our own biases. But I think most of us inside and outside the system see gold at 10, 12, 15, 20. I was talking to Pierre Lassonde. He's obviously a clear expert in the mining space, but he could say with a straight face, in our lifetimes we'll see $20,000 gold. Does that mean it's tomorrow? Does that mean gold doesn't go down? No. Does that mean I'm absolutely certain? No. But that's the conviction I have, because gold can go to those levels only because fiat money has really no options left. And that's why Bitcoin and anti-fiat solutions, cryptos, have been getting so much momentum. And you don't have to be anti-Bitcoin to be pro-gold or vice versa. But for me, gold at 15, 10, 20,000 is the real end game. And even then, I save in gold and spend in fiat. It's insurance. That's it. It's a preservation asset. It certainly can go up in price optionality. But Egon, my colleague who bought gold at 300 decades ago and sees it at 4,000, isn't doing a victory lap. He still saves in gold. The price has changed, but you're measuring the price change in fiat money. You might as well be measuring in something like chickens or anything else, or whatever. It's not really a good measure of the value of the asset. It just holds its value better than the dollar. Long-winded way of saying, I'm holding it for the long term. If it has retracements even 30%, I'll use those as buying opportunities. Yes, I'm selling my book. Yes, I'm gold biased. And yes, you could have a different opinion on that. But I think the very fact that the Bank of International Settlements, the IMF, even whales like Morgan Stanley see this, and they see it because their clients see it. And they see it because the writing's all over the wall now. It's no longer, again, a gold bug apology. It's the motions of history, from Adolf Thiers and Sir Thomas Gresham to Reinhardt and Rogoff to von Mises. I mean, this is just another credit cycle, and it means it's another fiat currency cycle.
Growing uncertainty around the integrity of reserve assets is reshaping how nations think about currency, gold, and the future of financial stability. The debate over U.S. gold holdings, the absence of credible audits, and the imbalance between official figures and geopolitical realities are creating renewed attention on revaluation strategies. A higher gold price would provide the Treasury with instant liquidity, but only if the underlying reserves are credible and sufficient. At the same time, concerns over asset seizures, highlighted by the freezing of foreign-held reserves, are prompting countries to accumulate physical gold as insurance amid a shifting power landscape. Parallel to this, proposals for gold-linked treasury instruments and emerging stablecoin frameworks highlight a system in search of new anchors. These digital structures create new demand for treasuries and enable rapid global transfers. Yet, they also consolidate power among financial intermediaries, while providing only a temporary cushion for a deeply indebted system. Now, let's get back to the interview.
The other argument is, well, first of all, we don't have an audit of what the U.S. has. Maybe it has infinitely more than 8,131 tons. Maybe it has infinitely less. Maybe there's something the U.S. knows, or certainly it wouldn't be surprised if they're not disclosing. I don't know. The argument that I would say, if we revalued the certificates we have, these 261 million ounces of gold and these certificates at $42 to the spot price of gold today, that would be a huge mistake unless we have a heck of a lot more gold than we say we do. Because at the current World Gold Council breakdown, U.S. theoretically has much more gold than Russia and China. That's an absolute farce. I mean, I don't think that's really believed by anyone in the space. China has infinitely more amounts of gold because of the way it produces it and the way we track it off the record than the U.S. does if we have 8,000 tons. And as Kissinger warned, if you revalue these certificates to spot, to basically make QE out of gold, you don't have to print money, you just revalue gold to spot. Those certificates can move up in value. You get a couple trillion, maybe $1 trillion, depending on the gold price, in instant money, instant liquidity that you can throw into the Treasury General account and pay off some debt for Uncle Sam. But if you do that, make sure you have the most gold when you do, because you're basically now taking your last bullet. And you're going to revalue this gold, and you're going to get a big chunk of liquidity that you'll burn through in probably one fiscal year at the current price. Why not wait till gold's at a higher valuation, A, before you revalue, and B, make sure, as Kissinger warned years ago, that you have more gold than your adversaries. Because if you revalue, well, that means China and Russia are going to have a heck of a lot more leverage in this new world order if they have more gold than the U.S. That's the trillion-dollar if. My gold buggy weird nature is, I think, Russia's not even listed on the World Gold Council. I think they have at least 12,000 tons. Could be dead wrong. Could be a conspiracy theory. Could be nuts. And we think, between Alistair McLeod and myself and the work we've done, I think China probably has at least 30,000 tons. So that would make China far more powerful if gold becomes part of this new power game in currency or liquidity. And so, again, these are premises that could be wrong, but I have a strong belief that China has more gold than the U.S. That said, we'd have to conduct an audit first. And I don't know how much gold the U.S. has. According to World Gold Council, about 8,000 tons. You mentioned Judy Shelton, and regardless of revaluation or Kissinger and all this guesstimating on what's going to happen tomorrow, I think it's important to know that the very fact that Judy Shelton wants to, and she's very convinced we will, have a long end of the curve gold-backed U.S. Treasury, whether that happens or not, and she says it will, and I don't know, and you don't know, but the very fact that that's even raised as an issue in the new world we live in, again, unthinkable 5-10 years ago when the world still thought the American dollar was immortal and that we were the king of all things. The very fact that Judy Shelton's even introducing this idea and taking it seriously, what is she really saying? She's saying for our treasury to be trusted, it has to be backed by gold, because if it's just backed by the US dollar, it's not going to succeed. So she's confessing out loud that we need gold to give credibility to our own IOUs. In other words, we need gold to give credibility to our unloved dollar and our unloved U.S. Treasury. And I think that's an important thing to keep in mind. So we need to find some new way to make this dollar and this US Treasury likable, or at least absorbed. Otherwise, we just have to keep printing more. And there's a limit to how much we get away with that. Enter the Genius Act, enter stablecoin, and enter JP Morgan and Circle Internet and fintech companies that can issue stablecoins. And it's a brilliant propaganda job because they're saying JP Morgan, Circle Internet, these major beasts they're getting a huge king-making opportunity here. It's an insider trade because, hey, I'm going to give you guys all over the world, that really frustrated doctor in Istanbul or that guy who doesn't trust his currency somewhere in Czechoslovakia, you're going to get an e-dollar, super fast, super transferable, super efficient. And we're going to give you this wonderful, wonderful e-dollar. What they're not saying is, well, you're going to give us $1 for that e-dollar. We're going to back it with a U.S. Treasury. That creates demand for the U.S. Treasury. That's great. It creates demand for the U.S. dollar. That's great. So that solves a couple problems at a minimal level for Uncle Sam. It also means that, hey, I'm the fintech company or I'm JP Morgan. I'm issuing you this stablecoin. You get a stablecoin with $1. I get your dollar and I get to get interest on the U.S. Treasury that backs that stablecoin. So I get an arbitrage worth billions of dollars annually to me, which is why Circle Internet is making so much money right now, because they're getting yield while you get an e-dollar. You're basically buying U.S. Treasuries and getting no yield for it. Well, the other thing is, that's why it's so ironic. And this is why everything from the Patriot Act to the Genius Act to all these euphemisms mean the exact opposite. Because first of all, stablecoin is not stable because it's backed by U.S. Treasury. We saw in 2023 the Sigma moves in the U.S. Treasuries. They were crazy. They were historically unprecedented moves. So the U.S. Treasury isn't necessarily stable, but for now, it's yield for the fintech. It's yield for JP Morgan and these stablecoin issuers, but it's not that stable in the long run if you think about the bond market the way I do. And it's not a coin, it's an e-dollar. So it really is, it's a kingmaker for JP Morgan and fintech. It is a semi-decent sponge for Uncle Sam to absorb some of these treasuries. I think it's a guppy solution to a whale of a problem. Even if they get 3, 7, 4, 5, 7 trillion in stablecoins issued, that's not enough to cover 38 trillion in counting in Uncle Sam's debt, but it's better than nothing. It's a Band-Aid solution. It's another executive order. It's another attempt, which is better than anything else that's tried, but it's desperate to me. But it's fairly brilliant, but as usual, it's misrepresented. And as usual, it benefits the issuers and the insiders to the Genius Act. And by the way, if I see Cantor Fitzgerald somewhere behind the legislation or something, I tend to distrust it. That's just my bias. But it's empirically really not a great thing for the end user, the stablecoin buyer, other than it's very quick, transferable e-dollar. It's a wonderful thing for Uncle Sam, and it's certainly a fortune maker for the fintech insiders who issue these. And I'll just end by saying the same thing. Stablecoins are issued by fintech and commercial banks. That is still a central bank digital currency. It's just not issued by the Fed. It's issued by fintech and banks. And so what these politicians so brilliantly did when they issued the Genius Act in the same week, they said, we're also introducing an anti-central bank digital currency bill because we're protecting our citizens from the appalling natures of central bank digital currency everyone's afraid of. Well, they just gave you the same thing on the left hand by hiding on the right. Stablecoin is just a fintech centralized digital currency. It's just as trackable and programmable as CBDC.
Growing doubts about the reliability of official reserve data and the strategic use of financial sanctions are reshaping the global conversation around gold, stablecoins, and the future of U.S. monetary credibility. The lack of transparency surrounding national gold inventories, combined with the steady rise of off-ledger accumulation by major economies, has made revaluation a far more complex and politically sensitive option. At the same time, the emergence of stablecoin frameworks backed by Treasuries offers short-term liquidity relief for an overstretched system, creating fresh demand for government debt while quietly shifting power toward large financial intermediaries. These mechanisms provide rapid digital transferability, yet they function as temporary bridges rather than long-term solutions. The underlying pressure, driven by debt expansion, eroding trust, and geopolitical realignment, continues to build beneath the surface, signaling more profound shifts ahead for global finance. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.